hate to break it to you, all of you who have not bought a house, who were telling me in 2020 that you were going to wait for a better market and you still haven't bought, your mortgage payment now is probably going to be $1,000 more than it would have been if you bought back then. This is a hard, frankly, sucky time for many first-time home buyers. So today I want to give you a little bit of a breakdown about what is going on in the real estate market with this housing market update. So let's get right into it. Redfin released a new study with the big headline being nearly everyone with a mortgage has an interest rate below 6%, prompting many to stay put. As a realtor who's actively working with clients through this market, the two biggest things that I can confidently tell you are affecting first-time home buyers is lack of inventory and the interest rates. And honestly, these things go hand in hand. In this study, they say roughly 4 in 5 homeowners with mortgages have an interest rate below 5%, and nearly 1/4 have a rate below 3%. With rates now close to 7%, many homeowners aren't moving, which is intensifying the shortage of homes for sale. So because the current homeowners who have bought homes in the past few years were able to lock in really these historically low interest rates, they're staying put. So that adds to our lack of available inventory for many buyers looking to purchase now. On top of that, the lack of inventory is causing these multiple offer situations, home prices to still stay high, and purchasing power is down for home buyers because they're having to deal with the interest rates that are affecting them right now, which are almost in the 7s. Not an ideal situation. As you can see in this chart here, more than 9 in 10 mortgage holders have a rate below 6%. I want you to think about this and put yourself in the shoes of a homeowner. If you had locked in one of these rates, you may not have any extreme motivation to sell for any outside reason. If you have a 3%, would it make sense for you to sell right now and then have to go buy something at potentially up to a 7% rate? Probably not. And that's the situation that many of these sellers are in. They go on to say that well over 92% of homeowners with mortgages have mortgage rates below the current weekly average of 6.71%, which is near the highest level in over 20 years. So contrary to the YouTube video headlines, what the news may be pushing, there hasn't been a big housing market crash this year. At the same time, values aren't coming down or falling as quickly as many people wanted you to believe. And this is most likely due to this lock-in effect. Redfin elaborates on this. They say many would-be sellers are staying put rather than listing their home to avoid taking on much higher mortgage rate when they purchase their next house. This lock-in effect has pushed inventory down to record lows this spring. New listings of homes for sale and the total number of listings have both dropped to their lowest level on record for this time of year, which is fueling homebuyer competition in some markets and preventing home prices from falling further even amid tepid demand. So even though the share of homeowners with mortgage rates below the 5s and 6s is weakening as more people continue to buy homes at today's interest rates, it's still true that every new homeowner who's purchasing a home with a loan would be subject to the higher mortgage rates. Because they're staying put, this has led to slim pickings for home buyers. You might be seeing this in your market. Pending home sales are down 17% from a year ago. It's so interesting to me because I see people trying to blame all these different things for what's going on in the market. But really, these higher interest rates are a double whammy for both buyers and sellers. They're discouraging sellers so much that even the buyers who are out there are having trouble finding a place to buy because there's limited inventory available. Redfin's deputy chief economist Taylor Marr said that the lock-in effect is unlikely to go away in the near future. Mortgage rates probably won't drop below 6% before the end of the year, and most homeowners wouldn't be motivated to sell unless rates drop further. There was a Redfin study done that revealed that 27% of U.S. homeowners who are considering listing their home for sale in the next year would feel more urgency to do so if rates dropped below 5%. Then that even goes higher, up to roughly half of homeowners would feel more urgency if they were to drop below 4%, and 78% of homeowners would be interested in listing if rates were to drop again below 3%. Interest rates that low were driven to save the economy. They were an emergency response to the COVID pandemic. So it is not likely that our economy would ever get to a point again, at least in the near future, where interest rates are going to be that low. Sure, could we see them go back down to like the mid fours like they were in 2018? Of course. And that would definitely help you when purchasing a house, but it's just something to keep in mind. So a drop down to maybe a mid 4% would be great for a home buyer, but don't wait out for 2% rates again. So people who are buying a less expensive home than the one that they're currently selling, perhaps because they're relocating to a more affordable part of the country or downsizing, may be more likely to move even if it means taking on a higher rate. This was the statistic that was mind-blowing to me. The typical monthly mortgage payment has increased $1,000 over the last 3 years as rates have risen from record lows and home prices have increased. I hate to break it to you, all of you who have not bought a house, who were telling me in 2020 that you were going to wait for a better market and you still haven't bought, your mortgage payment now is probably going to be $1,000 more than it would have been if you bought back then. It stings. It does. And here's how Redfin has come to this conclusion. The typical home buyer purchasing today's median priced US home, roughly $380,000, at the current average 6.7% mortgage rate, would take on a monthly payment of roughly $2,600, a record high. Think about this for a minute. Consider these typical homeowners. The first one, bought in 2018. Buyer A bought their home when the median US home price was around $280,000, and the average 30-year fixed mortgage rate was around 4.5%. Their monthly mortgage payment is about $1,540, which is more than $1,000 lower than the $2,600 it would be if they bought a home today with today's rate. If you bought in late 2020, buyer B bought their home when the typical home was selling for around $320,000 and the average rate was about 3%. Their mortgage payment is around $1,540 per month, more than $1,000 lower than it would be if they bought a home today with today's prices and rates. If you bought in mid 2022, last year, buyer C bought their home when the typical home was selling for $425,000 and rates were around 5%. Their monthly mortgage payment is around $2,400 per month. That's $200 lower than it would be today. As home prices have come down since then, but rates were already on the rise, that buyer, the buyer who bought just last year, might not feel locked into their mortgage rate, but they're also not very likely to sell considering they just bought their house 1 year ago. So you know me, I'm not one to install fear in you. I'm also not going to tell you that this is the best time to buy because frankly, it's not. It is a sucky market. Here is my suggestion. As you know, as I have always preached on my channel, you have to reflect on your personal finances and figure out when it is the right time for you to buy, which honestly is just reflecting on your debt to income ratio, your credit score, how much you have in savings, and thinking, can I, with what I have, be competitive in this market today? If not, that's fine, I'm gonna wait. But the main thing that I don't want you to do is try and time this perfectly. If I were to time every single home that I were to buy perfectly, I probably still would not have even owned my first home. I would not have bought my first home because ever since I have been looking to buy and ended up buying my first home in 2018, there has never been a perfect real estate market for buyers. It just doesn't exist. So the biggest thing is, how can you use what you have and analyze the market that we're in, and how can you learn to play the game? If you are a buyer, I see you. I hear you. It sucks. It is not a fun time. But the main thing that I want you to know, and this is what I'm talking to my clients about every single time we get together, is you need to keep in mind that cash is going to help you. The more you can save, the more you can put down on a house, the better, because these interest rates are high and they are directly impacting your monthly payment. And your DTI ratio, your debt to income, is going to affect how much you can afford on a monthly basis. If you don't know how to calculate your DTI, I just did like a complete walkthrough of that, so I'll link that above. Instead of putting 3% down, try to aim for like 5 to 10%. That is going to help you get more house, but still maintain in that comfortable monthly payment range. The second thing, possibly look at waiting until fall or winter time because there might be less buyers during that time just because of seasonality. A lot of people right now are trying to get things wrapped up in the spring and summer months while kids are out of school. Have you decided to continue with your home search? Are you holding off? Let me know what you are seeing and how these interest rates are affecting you. If you need help connecting with an agent in your area to help guide you through this process, an expert who knows the ins and outs of what kind of competition you may expect with your offers, make sure to check out the link in my description where I can help you get matched with a great professional in your area. If you found this video helpful, make sure to give it a thumbs up. I'm Nicole Nark with videos to help you find your way home, and I will see you in the next one.